Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Global stocks hold on to gains as the US president signs a bill ending the longest government shutdown in history. But it could take weeks to fully reopen the government. German industrial giant Siemens cuts its healthcare holdings as it continues to simplify its business and focus on software and AI in another busy earnings day in Europe. Plus, the Ukrainian President Volodymyr Zelenskiy tells Bloomberg his country's survival depends on aid from allies as the war with Russia rages on. We'll bring you more from that exclusive interview.
In the meantime, a quick check on these markets. Green on the screen yet again when it comes to the futures picture. Your Stocks 50 futures higher by 0.3%. The S&P right on its heels, 0.2% higher. But to me, I think the focus is really going to be on the bond market and the FX market as we await the data story. 409 on the 10-year yield, 115 on euro dollar. The countdown to the opening trade starts right now.
With my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
So it's over. The shutdown is behind us, at least for now. There could be another one coming to us very, very soon. But in the meantime, we are going to see the US government reopening over the next few days. And maybe, just maybe, the fog that has plagued the Fed over so many recent weeks, Kriti, begins to clear.
It's a fascinating one because really what we're waiting for in the interim until, of course, we barrel towards the January 30th deadline where, again, we go through this all over again, is we're waiting some of the airlines to open or the air carriers to start getting a little bit more capacity. We're waiting for some of the furloughed workers to actually come back to their jobs in Washington. There's questions about how much of that is front-loaded. But I think the key piece for the markets is when do we get this data, if at all? And that seems to be something that maybe markets aren't doubting just yet, but should they be?
Right, yes, the timetable as to when we get it, and then, of course, what it shows. And we've had this conversation a number of times around the desk that maybe some things are just delayed rather than never happen. But the cliche being you don't go for two haircuts, so there will be some kind of impact. But Berenberg pointing out that the CBO has estimated a 1.5 percentage points impact on Q4 GDP if it were to last 6 weeks, which we were short of. But still, it underlines the extent of the impact that we could see here. Federal workers, that's 1.8% of employees. Those who receive those food benefits that we've talked about in the programme, SNAP, that's 12% of households. So all of these things, this money that didn't go out, will have been having an impact in the short term.
Let's just talk about the schedule. Caroline Levitt, the press secretary, talking about the idea that maybe actually we would not get CPI, maybe we wouldn't get some of the jobs data for October. We'll wait and see. I think probably there could be a case for maybe delivering the jobs data. Whether or not we get the CPI number, I think, is an open question. The data surveying series around that is much more difficult. But when do we get a clean number, I guess, is the other real question. And when are we going to have sufficiently sort of a clear view of the landscape with no fog in it to be able to understand really what is happening? And that really is what the Fed is waiting for. But I think we could get a schedule fairly soon in terms of the data releases that we are going to get delivered by the BLS. That will be very important. It's not a return to normal, but it's a step closer to a normal data release series. And that's going to be really important for the market. The question, to my mind, is does it come with volatility? Once we start getting these numbers being released, are we going to see maybe bond markets in particular jumping around a little bit? And what are the implications of that for other assets?
Well, Caroline Levitt, the press secretary, said yesterday the Fed is flying blind, and they kind of have to. And we already knew we might not get the CPI numbers. We didn't know that we might not get the labor data as well. And I think this is really crucial because it comes on the same day as Susan Collins over at the Boston Fed made some comments, yet again, adding to the chorus that maybe the December rate cut isn't a sure thing.
Yeah, I mean, the Fed flying blind, markets flying perhaps partially sighted, because we have had some data, but not the full complement, of course. And so this is going to be really revealing. Have markets mispriced what's been going on over the last 5 weeks or so, or not?
How are we feeling about the UK?
How are we feeling about the UK? Well, the pound has dropped. I can certainly say that. That suggests that some of this data has come in a little bit weaker. So let's check out the details. We've got GDP. This is quarterly GDP. But if you look at the quarter-on-quarter number, so how the third quarter performed against the second, we've got an increase of just 0.2%. That's lower than was the estimate. It's lower than the prior number, so that's not moving in the right direction. The year-on-year picture for GDP, again, similar path. It is up 1.3%, but that's not as high as had been been expected by the markets. So the pound reacts negatively. We have to remember that we've already had a sort of shock into more negative expectations around the UK economy this week, because we've got that labour market data earlier on this week, and those who took it seriously said this is going to mean more likelihood of cuts, and we got the pound dropping there. But we've seen more of that this morning. But some economists said that labour market data, you just can't rely on it.
OK, so what does this mean for the budget? What does this mean for the Bank of England? I guess is the real question. This is an economy that looks like it's weakening. Is this... there's two questions. Does this imply that we are going to see further cuts? Does this imply that actually that December cut from the Bank of England is now more likely? On balance, maybe that is what the pound is signalling this morning, you could argue. How does it affect... How will it affect the reaction to the budget, I think is the other question. Not how will it affect the budget, but if you think about the fact that we're going in with a weakening trend, how will it affect people's perception of what is delivered within the budget? So that could change at the margin as well. But
in the meantime, in the countdown to it, the jitters, the political jitters, kind of showing up in the currency just a little bit. We're going to dive into that later on in the program. In the meantime, let's go straight back to the topic of the United States. I want to bring you some sound. The White House, of course, saying the September BLS data will be published after the reopening, but suggesting we won't see any data when it comes to the month of October. Take a listen.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released.
The Press Secretary Caroline Leavitt speaking there, and we should get a little bit more analysis in terms of what this actually means in terms of getting that data set. Jennifer McCown, Chief Global Economist over at Capital Economics, joins us around the table. Pleasure to have you. You picked a great day. Happy government reopening day to you, if we can call it that. Talk to us a little bit about this data set, then we'll talk about the broader economy. We always knew that the October data set was going to be a little bit messy, given the government shutdown. Doesn't matter that there's a possibility that we don't get it at all.
Yes, it really does matter. I mean, what we know is that we should at least get September data. The non-farm payrolls, that report was had already been put together more or less, so we should see that quite quickly. But of course, by the time the Fed meets in December, that's quite a long time ago, the September data. So that news that we may not get the October figures at all is a real concern and does leave the Fed in a bit of a fog. It has some other data. The ADP employment report, it has various surveys to go on, but we know that those have been pretty unreliable in the past, so it is going to be a very uncertain time. One thing that's happened in the past is that the statistics agencies have grouped publications together, so perhaps you get the October and the November data at the same time, but that could just further delay the release of the November figures if they're trying to put together the October figures too, so that there's really no great outcome, I think.
Is there clarity when it comes to what the damage of this record-breaking shutdown has actually been? As we wait for things to open up, as we wait for the data, as we wait for the airlines, is there an economic impact of this 42-day shutdown?
Yeah, well, unfortunately, it's difficult to tell because we haven't had the data, of course, which is the
chicken and the egg.
Yeah. But what we do have, for example, the Chicago Fed produces some advanced retail sales data known as the CARTS data. That looks okay. It's pointing to about 4% year-on-year growth in consumer spending on that basis. So things on that front look fairly good. The jobs data that we have look okay. The ISM services report rose. So far, it looks like the economy is faring fairly well, but those official data are going to be really, really important and could paint quite a different picture.
Which is the biggest problem for the US economy right now, inflation or the labour market? What happens in December, I guess, is the question I'm asking with the Fed. Which one should they focus on? Yeah,
I think the bigger question for the Fed is going to be the labour market at the moment. It looked like the inflation data were, just edging up. We were seeing some signs of an impact from tariffs, but mainly concentrated in particular sectors. And the Fed itself has indicated that the labour market at the moment is a bigger concern. So I think any data on the labour market that it can get its hands on is going to be
Do you think the data are going to clear the fog enough for the hawks on the Fed, who are more worried about the inflation side, to side with the idea that actually we should see a cut in December? Because this cut in December looks like it's on... the market has significantly repriced it.
Yeah.
We don't know yet whether or not we're going to get enough data or enough clarity by then to deliver that cut.
Yeah, that's right. And the interesting thing for me is I'm not sure what fog means. Does it mean that you carry on with your previous flight path and that would probably be a cut based on where we were headed before? Or does it mean that you just pause? And actually what Powell said was that if you're driving in the fog, you slow down. So maybe that means that we don't get that cut and that the Fed just goes on pause to wait and see.
Do you think that's the most likely
when
outcome?
those data are available. Actually, we think the most likely outcome is probably another cut in December, but I think it's really finely balanced, very close.
Okay.
Jennifer, can I ask you about, sticking with the US economy, but ask you about AI, and this is linked to the job story we were just talking about. And there's been lots of people who are worried about the job story, and you've expressed some concern about what's going on in the jobs market. How much of this is something cyclical? How much of this is something structural around AI? Because on the one hand, you have lots of CEOs sounding pretty bullish about their future prospects. You see that from the transcripts of calls on S&P companies. But on the other hand, you have a lot of nervousness around the jobs market.
Yes, yeah. But people are right to be nervous. This is kind of uncharted territory. But I think there are some encouraging points from the AI perspective. One is that the weakness in the labour market is not particular to the US, and we know that the AI drive has been very much focused in the US from the data that we have, and yet we're seeing labour markets weaken around the world, so that's not a good thing, but it does suggest that we can't pin this all on AI. And also, we've not seen really a big enough pickup in productivity in the US to be able to say, right, workers are being replaced with AI now. And that is what you would see if that was happening. So we are not overly concerned that this is a huge structural development, that we're going to see this these huge layoffs in future, but nonetheless the softness of the labour market is concerning, and some of that is probably down to jobs being replaced.
Pivoting to the UK, we talked about the pound dropping a little this morning. The UK economy barely growing then in the quarter before Rachel Reeves' budget. Tax rise fears, cyber attacks at Jaguar Land Rover, all kinds of things that you seem to be able to pin this on. That weighed on car production, of course, during the quarter. What are how does this backdrop affect what happens around the budget? I mean, maybe it's too late, maybe she's still got decisions to make, or maybe it's all done. But how does this kind of weak data picture affect what we're going to get at the end of November, do you think?
Yeah, I don't think it changes very much. We already knew that the data picture was pretty weak. We knew that the OBR was revising down its productivity forecasts, and so the outlook for the economy was softer too. So I think really the Chancellor, this just leaves the Chancellor pretty much in the same situation. I think as you were suggesting earlier, it does change the mood going into the budget though, and might change the way that people perceive it. The fact that it's clear that right now on the latest data, the economy is barely growing, and at that time, the Chancellor's going to be pushing through some pretty major tax hikes. I think could mean that the sentiment impact is bigger than it would otherwise be.
Jennifer, great stuff. Thanks for dropping by to see us this morning.
Welcome.
Lots of things to talk about. Jennifer McKeown, Chief Global Economist at Capital Economics. We've got lots to get through this morning. We're going to be speaking to Maya Bandari, Nibega Berman, EMEA Multi-Asset Strategy CIO. That's coming up a little bit later in the programme. We'll come back to the issue of the UK with Jordan Rochester from Mizuho. And it's another busy earnings day. Thomas Schultz, Bilfinger CEO, is going to be joining us a little later on as well. And Piero Alberto Folgiero, Fincantieri's CEO, massive Italian shipbuilder, going to be joining us. We've also got that conversation coming up.
Coming up on the programme then, the Ukrainian President Volodymyr Zelenskiy says his country's survival depends on aid from allies as the war with Russia rages on. We'll bring you more from our exclusive interview. Back in markets, we'll be focused on some of the earnings stories, the sales numbers coming through from Burberry. The luxury brand is called to open higher after surprising to the upside. Up next, WizzAir CEO Joseph Ferrari joins us around the desk. If you have questions, if you want to get involved in any of these conversations, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
Thursday the 13th, good morning. Welcome back to the programme. We've got lots of corporate earnings hitting the screen as we speak. WizzAir is one of those that we need to focus on. We'll talk about Burberry later on. We've got Bilfinger coming up as well. But let's talk about what is happening in the aviation space right now. Wizz's CEO is Joseph Ferrari. He joins us around the table. First half revenue numbers look like they've beaten expectations, but you're looking at a a capacity cut next year. You're looking at maybe a slower growth rate next year. Talk to us about kind of what we are seeing in terms of the business moving forward from here.
Good morning. Thank you for inviting. Well, first of all, I think we are reporting pretty reasonable numbers coming through the first half of the financial year. Notwithstanding the challenges in front of us, especially short term, next 6 to 12 months, we will still have significant capacity and we will still have significant issues with the engine cycle. Having said all of that, I think the business have kind of bottomed out, and now we're going to start seeing the benefits of restructuring. We made some, tough decisions in terms of addressing underperforming markets, reinvesting into high-performing markets, and we're going to be going through that kind of a maturity curve, and we will start seeing some benefits coming through.
You've just done a deal with Airbus that is going to reduce the capacity that you are going to be bringing on board. That is going to have a meaningful impact sort of starting later on in 2026. You were looking for a really big increase in capacity in 2026, sort of plus 20%. You're now looking at kind of somewhere around, what, circa 10% now?
Yeah, we are looking at a growth rate of 10 to 12%, okay, which we think is very manageable given the size of the business. We have very strong historical evidence, track record to prove that we can deal with that successfully. 20-30% could have been,
is that possible?
No, it is not. It is not. I mean, you can't grow the business of this scale 20-30%. That would have undermined financial performance on a structural basis. So that is the reason why we corrected the growth rate. But let's just put this in perspective. I mean, growing double-digit will still make WizzAir the fastest-growing airline in Europe.
Yeah, so that's still something to shout about. Good morning to you, Joseph. Let me ask you about some of the groundings that we've seen, the issues with the Pratt & Whitney engines. Are you still on track to resolve that by 2027? What does progress look like?
Yeah, as you can imagine, we have a very intense relationship with the manufacturer discussing this issue and the way to recover from that. I think we are fairly confident that towards the end of 2027, this issue might be behind us. We have a strong program in place in terms of getting engines into shops. We are investing a lot into buying spare engines to have more capacity to replace the affected engines. But it is a very heavy issue. I mean, we are an early adopter of this technology. In a way, it is backfiring on us at this point in time. But, given the indication for the future, I think once this issue is over, this is going to be the best performing engine in the world.
And do you have around 40 jets on the ground?
We have 35 at the moment.
35 on the ground as a result of this. And what have you learned? What's the business taking away from this, as you say, huge undertaking, this big experience that you've had, and how you stop it from happening in the future?
Probably
or manage it differently?
Yeah, probably we went over bullish on adapting a new technology. And you know that new technology in aviation always has kind of the bearing of risks, that technology matures. And if you are an early adapter, you take a risk. I mean, you take the benefit of technology immediately, obviously, but it comes with risk. So maybe we underestimated the risks associated with this. So definitely next time around, I think we have to be a little more reserved, a little more kind of sequenced in a way of onboarding new technology.
So that's on the engine side. Let's talk about on the deliveries side. You kind of mentioned this overcapacity story with Guy just a moment ago, but I want to ask it anyway. You talk about 88 deferrals when it comes to Airbus. Is that enough to give you the kind of flexibility you need?
We think so. I mean, you can imagine that this whole relationship between Airbus and WizzAir has been very flexible over 20 years. So we have been amending contracts over 100 times. So there is nothing unusual in terms of applying flexibilities when it comes to deliveries. But this is a structural reset. And basically, the way to think about this is that because of the groundings of aircraft, all of a sudden growing from that base, would have made the growth unachievable and undeliverable. And as a result, we had to do the reset. And we said that 10-12% is a proven growth rate what this business can deliver. But 10 to 12% means that we're going to be growing this business by 10-15 million customers a year. I mean, this is huge. I mean, this is the size of an airline in Central and East Europe, which we would be organically growing every year.
I mean, the numbers sound great, but in the meantime, as you try to get to those numbers, you've also closed your Abu Dhabi base. You're planning on closing your Vienna base as well. Are there others that you're thinking about?
I think these were the two main hits on underperforming markets due to various reasons. I think we have been talking about those reasons for quite some time. We are making some adjustments elsewhere as well. But we feel quite comfortable that the network design what we have and the churn of routes for profitability and enhanced performance are putting us on a good path to enhance performance from here on.
What's your assessment of what the consumer is looking like in Europe at the moment? Any sign of weakness? Any markets that look weaker to you than you anticipated? Any that look stronger?
We've seen that the consumer sentiment remains intact in Europe. I mean, of course, we have to understand the context of life, and the context of life is, life is becoming increasingly expensive for people. Energy crisis, housing costs are going up, and this is not a UK phenomenon. This is a European phenomenon that's happening everywhere. But it seems...
Is the consumer getting more stressed as a result of that?
Yeah, but at the same time, we also see that actually the consumers are prioritizing travel. So they still want to have good frills, small frills coming out of their life, and travel seems to be that kind of a segment to deliver on that. So we don't see any fundamental changes in consumer sentiments. Demand is there. People are buying. People are traveling.
You have a considerable business in the UK, Joseph. What are you thinking ahead of the budget? End of this month, we get a UK budget, and aviation is sometimes one of the sectors that catches the government's eye.
Yeah, look, I mean, I think every government, not just the UK government, is struggling at the moment in Europe. I mean, I think managing state budgets look like it's an uphill battle for every government. I mean, it is in Central and Eastern Europe, it is in the rest of Western Europe. I mean, you see some of the government political crisis situations here and there. So I just think that the reset on energy and the slow growth as a consequence of that is now distressing the systems. And it's everywhere. So I don't think this is unique to the UK. So I'm wishing good luck to the government to deal with it, but it is a challenge everywhere.
You talk about consumers prioritizing air travel, though. If they're taxed more on it, do you think that behavior will change?
We shall see. I think there was an assumption that consumer demand could collapse as a result of all these inflationary pressure on the consumers. That didn't happen. I still think that travel remains one of those sectors that will continue to flourish under any circumstances. Simply, people need a reset for themselves. I mean, they want to fulfill themselves. They want to go to see the world. They want to get some fun out of life, and air travel especially can deliver pretty well on that.
Michael O'Leary's about to get a lot more aircraft. Boeing's going to start delivering for him. He's a fierce competitor. He's a fierce kind of critic of kind of what you're doing. He thinks he can do it better. What do you say to Michael O'Leary with his new aeroplanes in terms of the competition and what it's going to look like in Eastern Europe?
Look, I mean, we have been competing with these guys for 20 years, and I would presume we will keep competing in the next 20 years. Do
you think he's going to get more competitive? He's getting new aircraft now.
Yeah, I mean, I don't think this is the real question, whether, they will grow, WizzAir will grow or not. I think the real question is what's going to happen to the others. I mean, these are two very capable airlines for delivering growth, and I think both airlines will continue to grow in the future, but that will put a lot more pressure on some of the other segments in the airline industry, on airlines that are actually not capable of growing. But let me tell you one thing, that if I just look at the market share developments in Central and Eastern Europe, actually we are up from 25% to 29% coming into early next year. So we continue to deliver, we continue to push capacity, we continue to grow, no matter what competition is doing.
Nice to see you. Thanks for stopping by to see us. Always appreciate it. WizzAir CEO Joseph Varadi on its numbers this morning. Coming up, Thomas Schultz, CEO of Bilfinger, is going to be joining us. We're going to talk German economy next. This is Bloomberg. Thirty minutes to the start of cash trading this Thursday morning. Good morning. Futures reasonably positive on both sides of the Atlantic. We're not up by much. US futures up by 0.2% when it comes to the S&P. As you can see, probably on average, that's a similar story here in the UK. The SOX 50 is up by 0.4%. There may be some slight regional variation depending on which stocks are performing this morning. But it looks like we are going to have, Kriti, a higher open.
Absolutely. When you look at the bond market, though, I wonder how much of the cue is coming from the States. You're looking at a 10-year at 409, higher by 2 basis points. Starting to see the indications higher begin, and not much action. The only one we're really seeing is in the German 10-year. Bund's higher by 1 basis point.
Yes, we've seen a bit of outperformance coming through from the French bond market, haven't we, as a little bit more stability has returned to that particular fiscal story. We'll see if that continues. 7:30 then here in London. Let's get to some of the other corporate reporting we're dealing with this morning. The German industrial services company Bilfinger has narrowed its sales forecast for the full year. Joining us now, Thomas Schultz, the CEO of Bilfinger. And Thomas, really nice to speak to you. Thank you very much for being with us. So the engineering services business that you manage, narrowing the guidance is one of the headlines coming through from your numbers this morning. So a little bit more certainty, perhaps. But you talk about a challenging market environment. How's business? How does things look right now?
Actually, the end markets where we operate in, predominantly in Europe, they are definitely under stress. We know that. But it's actually good news for us as Bilfinger because we help our customers. We support our customers in expansion times as well as in recession times to improve the efficiency. So for us, it's actually quite a good end market.
Quite a good end market. You have narrowed the guidance then today. So do you get a sense, Thomas, that there is a lot more predictability, a lot less volatility in your expectations for the year ahead compared to, say, 6 months ago?
Yeah, of course. We are in the middle of November, so the end of the year is quite close. The second thing is we said from the beginning that our target is in the revenue as well as in the EBITDA, the midpoint of the guidance. And that is actually what we prove with narrowing the guidance into that direction. On the other side, we see that our cash flow, which is for us unbelievably important, is actually coming in quite better than we forecasted. We lifted up the guidance significantly. We had in the quarter roughly 30% more cash flow than we had last year.
Thomas, it's Kriti in London. Thank you for your time this morning. I'd like to broaden out the conversation for a moment, if I can, and talk a little bit about the competitive edge that perhaps German companies like yourself have when it comes to things like overcapacity coming from China. How are you thinking about that relationship between German business and Chinese business?
Yeah, it's not about what I think about. The important is that any business, no matter what it is, in any situation of the cycle, is doing everything to be prepared for the next what happens, no matter if it's more pressure, as we see it in the chemical industry, especially in Germany, as well as for growth, like we see pharma all over. So from that point of view, what we see on our customer side is getting by far better prepared and doing the right things in the right direction, which makes in the future the industry definitely more resilient and more competitive.
Well, Thomas, is the German government doing things in the right direction, as you say? Is their plan one that's going to yield some fruit?
Oh, yeah, that's a very interesting question. I'll make it like that. The intentions are quite good. The stimulus packages are the right thing to do to invest into the defense. I think we don't need to talk about that. It's absolutely necessary. Infrastructure, it's definitely necessary. It comes too late, not too early. The question is how it is communicated and implemented, and there we can have different opinions.
Thomas, good morning, it's Guy. How much of business is related to customers that have AI data center exposure? How much of Bilfinger's business could ultimately be part of the data center build out?
Yes, it is part, as well as we are nuclear, as well as we are in all kinds of business where you move and deal with liquids and gases and energy and efficiency improvement on bigger plants. Data center business is important for us, not only from a business point of view, from an engineering, from a service point of view too. Because when you think about what the data centers are doing, take vehicles with no driver in it, this is then operated through data centers, and they have to operate 24/7. We are experts in maintaining business 24/7 for any kind of customer. So from that point of view,
what kind of growth rate do you expect there?
I think
just in terms of the growth rate that you could see from that part of the business.
Actually, we see growth rates in that area double digit, in the lower double digit part. That means 10, 15%. But it is not that you have a permanent coming in order intake. It actually goes in steps and in waves. So we are part of it as a supplier to the big suppliers into the data center build up, and we have quite a lot of offering in it. It's a good base business, at the moment more CapEx related, in a few years very much OpEx related.
Thomas, in a moment we're going to hear part of the interview that one of our colleagues has done with the Ukrainian President Zelenskiy. And I'm wondering how you currently think about what that market is going to deliver. There is going to be a need for a significant upgrade, an almost complete refresh of the Ukrainian energy infrastructure grid. How are you thinking about the scale of what is going to be required? What do you think is going to be required, and how ready are you to deliver upon that?
I think there's a lot of talk about it, but one thing, this is not the first country in a war situation. This is not the first country then any time coming out or coming into a kind of a ceasefire where the country has to get rebuilt. What happened is that especially the energy and what we call the lifelines of the country are actually demolished and attacked. This is drink water, this is energy, this is district heating. This is a lot of these basic infrastructure to make the living for the people in that kind of country possible. And we as Bilfingers are specialists to help countries, companies, societies to rebuild, to build that up. We are specialists in district heating, we are specialists in pipe work for networks, all of that. So when we look on Ukraine, of course, beside all the drama and all the very, very bad things happening there, it will be a big business in our business environment, definitely.
We hope that that time comes quickly. Thomas, thank you very much indeed for your time this morning. Thomas Schulz, the CEO of Bilfinger, on the numbers. As I say, the Ukrainian president wants frozen Russian assets to be used to fund the next stages of his country's war against Russia. He hopes that that will bring it to a rapid conclusion. In an exclusive interview with Bloomberg Television, Volodymyr Zelenskiy has said fresh European funding using Russian assets is now critical for sustaining his country's war effort, ramping up pressure, of course, on Brussels to end a long-running set of divisions over that plan. He's been speaking to our chief European correspondent, Oliver Crook, in Kyiv.
We need it very much. This is one of the types of real sanctions. Russia has to pay for this war. They began this war and they have to pay. This is a real fact, how they can pay. And we need this money. We will spend this money on renovation, and of course we need air defense, and you know we need air defense from the United States, and we have European systems. We need this air defense from European leaders. This is all very important. And of course we need to finance our drone production, which is huge. We need to finance it, and we don't have additional money. And this is the way, and this is fair, I think. They began this war and they want to continue it. That's why they have to pay.
Is this the most significant thing European leaders can do right now to help you?
Of course, we can get more than 140 billion for today.
Right.
We can get it. By the way, from the United States, it will be also a good signal, you know, like with energy, like sanctions of the White House, of President.
What?
Yes, it's about Lukoil and Rosneft and Lukoil. Important step. And it brought some our partners, European partners, also to some strong decisions. And we've been happy that there have been 19th package. We are thankful to Europeans for this. So that's why if President Trump, for example, will decide that he has some, I think more than 5 billion he has of assets, maybe he will decide to spend this money. It will help.
Have you discussed alternatives with allies about Russian assets if that does not come through? Is there an alternative plan? Is there a plan B?
No, they understand that we need their support, and if, I hope, God bless, we will get this decision, but if they will not have this decision, of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much, and I count on partners.
And on the question of, you brought Donald Trump in connection to the Europeans, why did it take Donald Trump to get the Europeans to ban Russian LNG?
He always said that he wants Europe to put sanctions on Russian energy. He always said that. That was during our meeting and etc. And you know that some countries in Europe, they really used it. Yes, it was not the case of 1 year. In the case of, I think, about 30 years, they had relations and a lot of different factories. They have common businesses. It's understandable. And then President of the United States, he said, okay, I'm ready, and if Europe will be ready. And of course, this decision, this way of sanctions was good, as I said to you, that it was American sanctions and European sanctions. It like split, and they came together, and I think this is good way. It was good way. And that's the same about assets. That's why I raised it about assets, that there are some assets in the United States. If the United States can do it, it will be helpful for European decisions also.
The Ukrainian President Vladimir Zelenskiy there speaking exclusively with our very own Oliver Crook, of course, in Kyiv. The conversation continues, of course, on developments when it comes to military technology. Palantir UK head Louise Mosley says that Ukraine is leading the charge when it comes to that innovation. He spoke to Bloomberg's Tom McKenzie for the next episode of Bloomberg Tech Europe on how AI is reshaping the defense sector.
I think we're living through two big global changes. One is geopolitical, and the other is technology. The interesting thing is they're happening at once. So you've got the world moving to a much more, well, let's call it, the moment of American unipolarity is over. There are now adversaries, particularly China, that are near peer or even potentially stronger than the US in certain ways. So that's a fundamental geopolitical shift. But at the same time, you're seeing a revolution in artificial intelligence. Technology which will change every aspect of our lives, not least defense and military.
You can see more of that exclusive interview with Louise Mosley in the next episode of Bloomberg Tech Europe. That airs, of course, tomorrow at 6:30 a.m. London time. The focus on defense and how AI has upended the industry. Tom McKenzie speaking with key players, including the co-CEO of Helsing, the managing director of General Catalyst.
Coming up on the programme, European equity market futures pointing slightly higher this morning. Shutdown to the fore, but also corporate earnings. Burberry sales rise as the UK fashion brand sees stronger demand in China. It's just one of the stocks we're watching at the open. This is Bloomberg.
Nobody's ever seen anything like this one. This was a no-brainer. This was an easy extension. But they didn't want to do it the easy way. They had to do it the hard way. And they look very bad, the Democrats do.
It's over, at least for now. Let's get Val's take on what is happening here and what it means for markets.
Well, it is frankly positive for the equity market. We have S&P Futures in the green. They're actually headed for their best week in 3 months, Guy. S&P Futures are up 2% over the last 4 days, also having to do with the rebound of the NASDAQ after its worst week since April last week. So positive for the equity market is the main takeaway. The other big takeaway is it's positive for the price of gold. The price of gold in the last 5 sessions has risen near 6%. Some of this is being tagged to just a liquidity play now that the government is back running as of today. You'll have the Treasury resuming their cash payments. Those cash balances at the Treasury have been building over the last 43 days. And that while this is positive for liquidity, that means it's positive for the equity market and it's positive for gold, with gold surely on the move again this morning, up 6% in the last 5 days. The other big question is the data backlog. Just when will we get it released? We do have confirmation from the Department of Labor that they are back to full operations today, and the BLS does sit within the Department of Labor. So perhaps we are due to get an update at some point today what the BLS intends to do with this data backlog, and especially what they intend to do with the October CPI that, Anna, was due to be released to the market today, but they have not been working on it over the course of the shutdown. And this gap in data, just what they intend to do, whether they intend to release the interpolated number or skip it altogether, could have big ramifications for the index for months to come.
Yeah, we were hearing from our guests earlier on in the hour how much that mattered. Valerie, thank you very much. Bloomberg's Valerie Seitel with the latest on markets. Let's continue the markets conversation in 3 minutes this time with our reporter from the Markets Live team, Skylar Montgomery-Koning. Very good to see you, Skylar. Nice to have you on the programme. So the big picture for markets right now, it does seem as if the end of the shutdown in the States has provided a little bit of positive momentum. Maybe that's short-lived. Let's see. Is this a driver higher for stocks and for gold, it would seem, that has legs?
Yeah, I mean, I think absolutely. We've seen momentum behind the equity market throughout this year, and this is just another positive driver. And the main point is growth, right? That's what equities care about. And what you see is as you have the U.S. shutdown end, that means you don't get the counterfactual, which is a much worse growth outcome. And so you can get boosted. I think the other bit of the puzzle is, yes, you'll likely have weaker growth within the quarter affected, but it'll be a V-shaped recovery. And equities can look through that V-shape into the other side. So it can still be positive. I think implications in other markets and for the Fed, though, maybe isn't quite as positive.
So we're trying to figure out what the Fed's going to do in December. Should the Bank of England be cutting in December?
I think what we saw this morning from UK GDP data would certainly confirm that bias. GDP data came in below expectations. You also had labor market report earlier this week that had unemployment rising as wages came down, and that tells you that the labor market is loosening. But more importantly for the Bank of England, it confirms what we got from the September inflation release, which was inflation is peaking. We're getting data since the Bank of England meeting that we had in November. That confirms that, and that should set you up for a December Bank of England cut, certainly.
What do you do with the FX space in this environment when you have these very key contentious issues on both the U.S. and the U.K.? What does cable do from here, given that we've seen kind of a bout of strength when it comes to the dollar?
Yeah, I think it's a little less clear in cable versus, say, UK gilts, because UK gilts is a clear positive, right? You have lower growth and inflation. You have a Bank of England cutting. That's very positive. For the pound, it's less clear cut, though, because what you have is a premium that likely needs to be lower than otherwise because inflation has peaked, and you get this virtuous cycle between yields being lower and debt sustainability costs. The second point is more along the lines of valuation. So gilts have room to rally, but the pound looks more cheap. So if you look at Euro GBP, for example, on short-term interest rate differentials, that points to a higher pound. If you think about just the level, Euro GBP heading towards 90, that's a level that we got to during the Liz Truss crisis. It's a very different economic environment now. So what I'd say is that looks very, very different. And then the third final point is just to be able to buy bonds, you don't have to take out a view on something else. Whereas if you're selling the pound, you have to be buying something else, and there's not anything really attractive elsewhere. Because your terminal rate is maybe 3.5%, maybe it's a bit lower, that's still relatively high within your global landscape, and so that means it's expensive to short, the carry is positive, and if you think that risk is going to continue to rally, if you think about your G4 currencies, the pound is the most high beta. So yes, you can very clearly take a case to be bullish on bonds, but I think for the pound it's less clear-cut that you should be negative.
Okay. Skylar, thank you very much. Yes, just as you were speaking there, we saw the pound respond negatively initially to the print around GDP. It dropped. Expectations building around a rate cut from the Bank of England, but then it's entirely positive now. It's rallied. So we will watch that with interest. Skylar, thank you very much. Skylar Montgomery-Koenig from the Markets Live team. Remember, you can get further analysis from all of the analysts on that team, from Skylar, from Mark, from the rest of the gang. MLI Vigo is the function to use on the Bloomberg terminal. Let's get to Chloe Melly for an update on the stocks we're watching. Chloe.
Good morning, Anna. Let's start with Burberry today after the company returned to sales growth for the first time in 2 years thanks to strong demand in China. So this will probably be taken as a sign that the turnaround under the new CEO is working, that the refocus on those Burberry classics like trench coats and scarves is paying off for that company. So we have already seen Burberry actually outperforming some of those luxury peers, some of that broader luxury index. So we'll see if that continues this morning. The CEO said that there was more to do, more progress to be made, but that it shows, this set of results shows that the company is on the right track. So we'll see if investors agree this morning. Moving on to Siemens, which could also be on the move after raising its outlook and setting new near-term and medium-term targets. This is part of a broader revamp that also includes trimming its stake in medical equipment business Siemens Healthineers and reinvest some of that freed up capital into AI and into software. So we'll see how those two stocks react this morning. Siemens was much stronger. Siemens Healthineers has seen a lot of weakness recently. And finally, let's end with the transport and logistics sector after a new Morgan Stanley note on that sector. DSV is the one that is actually a little bit weaker here, but this is the one that Morgan Stanley analysts have picked as the top company in that sector, saying that it is set for quite attractive earnings growth, while Maersk was kept at a sell rating and DHL downgraded. So let's see how that picture changes this morning on the back of this sector note and downgrades and upgrades from Morgan Stanley.
All right, Chloe Melly with some of our stocks to watch. We thank you so much. And sticking with the logistics sector, we should mention that Hapag-Lloyd came out with their numbers this morning as well. They're telling a similar story that we had with Maersk, I think, earlier in this week, where you are starting to see some of the freight prices actually weigh on their numbers.
Absolutely, but key factors still remain. Are we going to see the Red Sea opening? What's that going to do? How are we going to see maybe the evolution of the China-US story developing? All of those kind of still, I think, unresolved at this point in time. Looks like stocks are going to open a little bit higher. We've got a US opening. Is that going to be a better to travel and arrive event? What can we expect over the next few days? I don't know when we're going to get the data. I guess the next few days are sort of... Are we going to get a few sessions where we get clarity on the data?
Are we in a holding pattern until we get the data?
But does it even matter if we know that the data is going to be messy? Is it just the act of having a data set that's valuable? I can't quite tell. Or is it the number itself?
I don't know. It's going to be... and again, the Fed speak, which we're going to start to get... We've got quite a lot of Fed speak coming through. Is that going to be influenced by the data? Are we going to see any shift in tone? Because the Fed's so divided.
Yes, and that emphasis on inflation from some at the Fed. Will the data support the divisions at the Fed, I suppose, is the interesting point. Coming up on the programme then, we'll bring you, of course, the opening trade. Futures do point a little bit higher. US futures also higher, up by 0.1%, only on E-minis right now. This is Bloomberg.
Thursday the 13th, the shutdown in the United States is over. UK data is disappointing. There's a lot to fold into this market this morning. We've got a fair few corporates we need to put into the mix as well. I'm just not sure that the next few days are going to deliver maybe the clarity we would have hoped for coming out of this shutdown. Maybe we've got to wait until we actually get through a few more months and quarters, maybe I dare to say. But we've also got Nvidia still coming. So the recent ranges that we're in, are we going to be in them till we get to Nvidia? Is that going to be the story? Yesterday's a bit of a mare session. Yes, we were up a little bit, not really much to talk about. We were waiting for the end of the shutdown. That was the picture. Europe went out here. We closed at similar sort of levels. I'm not sure there's much read across into the session this morning, Kriti. Futures are a little bit higher, but at least they're higher.
An element of autopilot, I think, but higher for a third straight day, which is starting to make me at least feel a little bit nervous because the futures are in the green, but not by the same margin you've seen in the last two sessions, Anna. Higher by 0.2% on Eurostoxx 50 futures. To me, the outperformer is actually down here in France. CAC 40 futures outperforming by 0.4%. We'll see what actually stocks underneath the hood are driving that move.
Yes, and we could get underperformers then from the London market, as we saw yesterday. Let's pivot to some of the individual names in focus. We've had corporate earnings, and so some of those are in focus for us. Siemens. This one, they upgraded their guidance to some degree, and they're spinning off some of their holdings in the healthcare sector. But there is a bit more of a negative take from JP Morgan, quoting FX challenges and what they call opaque guidance. So we'll see whether that one drops a little at the start of trade. Burberry, sales rising at this particular UK fashion brand. They've seen stronger demand in the region that includes their key China market. So they don't split it out specifically, but that does tell a more positive story under the new CEO around China. And Deutsche Telekom to boost their dividend. German fibre rollout plans, or the demand for that's really lifting their guidance, Guy.
OK, here we go. Market open. There we go. Anna taking us right to it. And here we find ourselves with a market that is going a little bit higher. When we show you the numbers, the FTSE 100 right on cue delivers a lower number. But we are anticipating a reasonably kind of flattish open to the morning. I'm not sure the fog's clearing. Doesn't feel like the fog's clearing to me this morning. When do we start to maybe get a sense of better visibility going forward from here? Just doesn't feel like those are not numbers that kind of tell you about a market that is seeing clarity this morning. Stock 600 is absolutely flat. You've got the FTSE 100 down by 0.1%. As Kriti says, the CAC maybe some outperformance. We're up by 0.4%. Is politics playing a part in that, or is that a single stock story? Let's find out. Kriti, what do you got?
Well, my theory is simply that the French are outperforming because LVMH is outperforming. It's one of your biggest index contributors to the upside, at least in the early read here. A couple of other French stocks that are moving the market higher. I can't quite figure out why. It doesn't feel like an earnings story at the moment, but it is certainly one that's driving the index alongside some of the other heavyweights that are in your core six, the ASMLs, the Novo Nordics. If you are a large cap European megaweight, you are higher today. And you can see that kind of show up in the broad sector space as well. Media and utilities, Anna, on the back foot.
Yes, is there a Burberry read across into the French market? We're waiting for the Burberry share price to open, so we don't know where that one's heading right now. But the reporting around this story, the fact that we've got more detail and a more positive take on the China market could be something that traders in Paris might be watching pretty carefully. But we do have, the weight of moves is to the upside this morning, isn't it? The chemical sector is the best performing sector. Technology, autos, parts, a host of industrials, cyclicals moving higher this morning, it would seem.
Yeah, it feels like a defensive market at the bottom, doesn't it? Utilities are to the downside. You've got the grocery sector down. You've got the retail space a little bit softer as well. Healthcare's reasonably flat. Energy is a bit of an underperformer, though. There is this kind of narrative going around that the glut that we've all been anticipating is finally here. That's beginning to show up in energy prices. That's beginning to show up in energy stocks as a result of that. Chemicals is an interesting one in terms of the movement that we're getting there. Umicore is up quite strongly. Givaudan is up quite strongly. Lanxess is up. BASF is up. This is the kind of the precursor sector for the European economy. If you see chemicals outperforming, that in theory should be quite sort of cyclically positive. Looking at the mix this morning, maybe is that really the case? Is that the signal we should be taking from this? But at least they're up, and they've had a real tough time of things recently. You've only got to look at what is happening with Ineos and all kinds of stocks here in the UK to take that story on board. The German chemical sector has been struggling for a long time, so I'll take a positive day for that space.
A positive day. There's a couple of others as well. I'm just looking at Hermes actually climbing up the ranks when it comes to the outperformers of the Stocks 50. We'll dive into the luxury space in a moment when we get some more of those clearer read-throughs. In the meantime, let's broaden this conversation out. Maya Bandari, Chief Investment Officer for EMEA Multi-Asset Strategies over at Neuberger Berman, joins us around the table. Welcome to the set. We're trying to figure out what's driving these markets right now. You can see us do a little bit of detective work here, not really come to a conclusion. There is a thought, though, that some of the optimism, or at least some of the broader green on the screen, is being driven by the idea that the U.S. the U.S. government is no longer shut down. To what extent does that matter from a trading perspective?
So thank you for having me on the show. I mean, I think certainly the end of the longest shutdown on record is one of the factors that's driving markets this morning, although I think it's important to say that it doesn't really have much impact on the broader macro picture, right? Because essentially the way these things work is you take away from the current quarter and you give it back in the future. But look, I mean, I think the real concern of looking beyond shorter-term trading is around the data release. And, we learned yesterday, of course, that we're unlikely to get numbers for October for the labour market or inflation. And so the question I think markets will have to grapple with beyond today is really what the impact of that will be for the FOMC in December, because, of course, they meet on the 9th and the 10th. We're due to have the inflation and the labour market numbers for November just before that. And the question will be, as we were just discussing, whether that will be too foggy, to paraphrase Jay Powell, for the December meeting. Yeah. I'd say big picture again at Neuberger Berman, we're mildly more hawkish than I think rates markets are for where the Fed lands. So looking at markets this morning, we're at
mildly means.
3%, right? Is I think where the futures curve puts us, and we think we probably land at 3.5, which is our estimate of neutral. And really, underneath the hood of that is, the Fed is kind of grappling with an interesting situation, and an unusual one, because on the one hand, you've got rising productivity that's lifting growth without much inflation. And on the other hand, you've got a weak labour market. I mean, the last labour market numbers we had were pretty soft. I think expectations are that the ones that we have just in time for the next FOMC will be pretty soft too. And so it's a tough balancing act.
Well, if the data's messy and the Fed's thinking is messy and the market is pricing in a lot of cuts, does that just mean disappointment is what's on the cards for the next couple of months when it comes to these markets?
Well, I mean, I think, when you look at equities, it's, of course, your discount rate picture, your broad rates picture is important, but so too is your earnings picture. And I think what we have seen through this last earnings season is really quite punchy earnings numbers coming through. And so I think that has been what markets have traded off to a degree too.
And when we talk earnings, Maya, it's very easy to focus on the Mag 7 and whether the earnings stories will justify the valuations there. But you have a strategy that is broader now. You're thinking about not Tina anymore, there is no alternative, but Tara, there are real alternatives. Tell us about Tara and where that takes you.
I think that's a great point, and I think if we'd looked at last year, or frankly any year prior, I mean, the US was really the only game in town, and that hasn't been the case this year. We've seen that play out already, I'd say, in 2025. So look, I mean, for us, and just to be clear, that this is not a cautious view on the US. It's more a sort of at target view on US large cap, a more positive tilt towards US small cap. But from a global perspective, really seeking to emphasize areas like some of the emerging markets, China, where to your earlier point, you get exposure to AI at a very different price point.
Yes.
Japan. Where we've got, I guess in both cases, really, the two drivers of equity returns, earnings and the price you pay for those earnings, tilt positively to our minds.
Yeah, let me pick up on the EM theme, because our colleague John Althus has a piece out this morning saying America first is making emerging markets number one. You cite China. Is that the focus of your emerging market strategy? It is from a market cap sense, I assume, but wider than that, is it?
I'd say it is wider than that, and I think we kind of saw that in October, right? I mean, we saw that in October in markets like Korea, where we saw single names, Samsung, Hynix, moving really meaningfully on the broader AI theme, and the market overall up 20-some percent. And so a key theme for us at Neuberger, looking ahead to next year, is AI as a theme, if you will, and Tina to Tara as a theme broadening out.
Is Tara going to outperform Tina?
That's a difficult question. I mean, there's not necessarily, I suppose. Well, it depends on how you look at it. I mean, I think.
Okay. Am I going to get? People talk about diversification. There's a lot of people in that chair talk about diversification, and they talk about maybe looking at other markets. Are you assuming by making that kind of switch that you are, in the near term at least, likely to underperform? US outperformance has been there for quite some time. Is the price of diversification underperformance, and is it a price worth paying?
Right, I got it. So, I mean, yes, I mean, I think central to our asset allocation view, which is the preference for markets outside the US and equities, and frankly in bonds too, is an expectation that over the tactical horizon, those markets will generate above benchmark returns, more so than we see in the US.
In terms of, therefore, kind of how the portfolio evolves, like how much do I take out of the United States? Kind of, what are people? How sticky is that money in the US?
So we're not advocating, to be clear, we're not saying sell US. That's not the message. But I think the message is be a target on the US. You want exposure to some of these Mag 7 stocks. But actually, if you think about where you want to have...
the marginal difference.
But the marginal difference, if you will, the marginal alpha is going to come from markets perhaps outside the US. Markets like China, markets like Japan, markets like broader EM, where you've got both more valuation support, but also prospectively pretty strong earnings.
I just wanted to ask you about diversifiers. We were talking there a bit about diversification, and you like things like gold, also private equity. I'm just drawn to some numbers out of 3i, London-listed private equity business, actually dropping by 9% this morning on the back of those numbers. How much... explain the positivity around the PE sector. I mean, we can't go a day without talking about private equity and private credit, but what's the thesis from here?
Well, the thesis from here is, as you reflect, for us, a positive one. And I think, that the big theme with private equity has been that, that there certainly have been opportunities for some players. At Neuberger, private equity is a pretty core part of our business. And so we are finding interesting opportunities in the current setup, whether it's in secondary markets, whether it's providing liquidity to LPs and so on. And I'd say from a big picture perspective as an asset allocator, that 20,000-foot perspective, PE does give us that important diversification. I'd also say that every risk has attached to it a price. And when we look at the downside that's baked into broad PE multiples, things like EV to EBITDA, looping right back to the discussion we were having just now on the US public equity market, there is more caution baked in to PE than there is to public equities.
Just finally, to kind of wrap this conversation up, am I still in capital increase mode? Am I trying to grow my portfolio, or am I trying to defend my portfolio at the moment? What are your clients saying on that? Because that's a question I keep hearing time and time again. Is now the time to get defensive?
Broadly?
Broadly. It's kind of the mindset.
Well, I mean, I'd say now is certainly the time to be selective. Would be my message. Selective in private markets, selective in public markets, selective in fixed income. In fixed income, for example, areas where we're taking exposure are really in Europe, both in credit as well as government bonds.
Okay, Maya, thank you very much. Thanks for joining us, Maya Panzari, EMEA multi-asset strategist at Strategy CIO and Neuberger Berman. Let's get an update then on some of these individual stock movers. Chloe Melly has a briefing.
Good morning, Anna. So Siemens is down quite a lot this morning. We're down 4% as investors try and digest quite a lot of news from Siemens this morning. So it said that it would trim its stake in Siemens Healthineers, which is a medical equipment business, and it also set new near and medium-term targets. But JP Morgan analysts said that this outlook statement was quite mixed and flagged some pressure in margins, some currency headwinds, and said that it might lead the stock a little bit down this morning. And we are down 4% as a result of that. So it seems that this outlook is also quite opaque according to those analysts. Moving on, but staying in Germany, Merck, the science conglomerate, is up. It's up 6.4% this morning after reporting better than expected profit thanks to strong sales of some new tumor drugs. It also narrowed its profit forecast, and that is being received really well by the market. We have also got Delivery Hero, the food delivery company, also up this morning after reporting also a strong result, saying that the fourth quarter growth will accelerate, and that is thanks to strong trends in Asia, and South Korea in particular was singled out as a particularly strong market. And finally, SBM Offshore, which offers facilities and services to the offshore oil and gas industry, also raised its profit guidance this morning, and as a result it is up almost 6% this morning.
All right, Chloe Melly walking us through some of those early movers. We thank you so much for joining us. Coming up on the program, we're going to continue with the earnings stories. We're going to hear from the CEO of Fincantieri after the Italian shipbuilder beat estimates for its 9-month revenue results, but disappointed when it comes to the forward guidance. That conversation next. This is Bloomberg.
Welcome back to the opening trade. 16 or so minutes into our European session, and things look fairly flat, apart from the French market, which does seem to be outperforming, up by 0.6%. Little underperformance in London, down by 0.3%. Let's go to Germany, though, in terms of the share price response to the earnings stories. This is what we see for Siemens right now, down by 3.8%. It's interesting because the market seems to be focused on currency headwinds. They're talking about that being a strong burden to growth in revenue through 2026. So that does seem to be where the market has focused its attention, and some of the margin conversation. But this is a business that is increasingly simplifying itself, reducing its exposure to the health sector, for example, software, AI, data centers. These are new buzzwords over at Siemens, as you would expect. I spoke a little earlier to the Siemens CEO, Roland Busch, and specifically asked him about the guidance story over at Siemens.
The midterm target we increased even to 6 to 9%. This, by the way, excludes Siemens Healthineers. And as I said, the reason is that we have highly competitive offerings due to our long-term investment, for example, in our software suite. We invested 28 billion in our software suite, which is today in industrial software maybe the most competitive one. If you want to build a digital twin of anything, we can build it for you, the most comprehensive physics-based digital twin. And we invest in AI. We talk about investing in AI technology in the next 3 years, 1 billion. And it's not new to us. We do that for many, many years. We have a lot of offerings already, but we are doubling down on AI, and we talk industrial AI. We bring AI now to the industrial world. So when we are serving very strong markets, we are serving the digital markets. They grow faster. These markets grow by 11%. We are investing and growing in the regions, the key regions, United States, China, India. And we are also doubling down on what we do in Germany, by the way. And we are investing and growing in verticals. We have growth verticals, which are super interesting, like semiconductors, big growth verticals, pharmaceuticals. This is a business, a market which is in its transformation. Data centers, and just to name a few. Healthineers
is a business that you're going to take part of and do a direct spin-off, around 30% of it going to be handed back to shareholders. Can you tell me about the rationale and the reason for doing it in this way, the reason for choosing this solution for your Healthineers stake?
Yeah. So first, we are doing that out of a position of strength. Strength for Siemens, but also for Siemens Healthineers, a business which is doing very well. But we recognized that the the market, but also the businesses, they are drifting apart. For example, Siemens Healthineers is going more and more into clinical part, into therapies. Digitalization does not scale in the healthcare space for regulatory reasons. It's very much regional, as it does for our Siemens business. We're also talking about the growth. We want to unleash our growth, go for the next growth level, and we believe we can do that if we separate more, and every company can allocate capital according to their needs even better.
The Siemens CEO, Roland Busch, speaking to me earlier. A much transformed business from the company that we would have spoken to some years ago, investing €1 billion in AI over the next 3 years. And in terms of M&A, they've done a lot of it in different parts of the AI space already. They're hiring in the AI space as well. And in terms of that M&A, they're actually looking, yes, it's a software business increasingly, but they're actually looking at some hardware that generates data, because they see that that is also an M&A target for this company.
Let's turn our attention firmly from the kind of software space to the hardware space. Italian ships. Italian shipbuilder Fincantieri posting a 20% year-on-year increase in its 9-month results yesterday. The shares fell. Media banker analysts suspect that actually it was high expectations when it comes to maybe a guidance upgrade that the market was expecting but didn't get. Fincantieri's CEO is Pierroberto Folgiero, and he joins us now. Good morning to you, sir. Thank you for your time today. Let's just start off with the numbers and the expectations for 2026. The market was maybe looking for an upgrade in terms, good morning, in terms of your guidance for next year. You've stuck to your current guidance. Why have you decided to stick to current guidance? Was there an option to upgrade?
You know, we are in the heavy industry business, so we tend to be very, I would say, step by step. So yes, we are driven by the trends of the defense sector, which is sparkling, which is fast track. But you know, we believe that quarter on quarter we have to deliver, and we have to deliver with an heavy industry business style, which is not to zigzag, but is constantly deliver on promises, as we did in the last 3 years.
Okay, and as a result of which you're going to take it step by step throughout this year. In terms of what this next year looks like and where we could potentially see some upside, where could it come from? There's a series of contracts that are up for grabs. I see that the Polish Navy needs some submarines. You want to get bigger in submarines. And I'm wondering whether you feel that you are big enough now. Are you going to be able to deliver on your expectations when it comes to submarines and submersible craft in 2026? Do you have the momentum and the capacity to deliver on that?
Absolutely, yes. Absolutely, yes. In the sense that we have a lot of product development going on and a lot of business development going on. The product development meaning new means, new vehicles, unmanned underwater drones that we have already demonstrated to the market, and we are in the commercial phase of it, as well as a lot of opportunities in terms of geographical expansion in geographies in which this demand is booming, because there is a huge naval demand for new kind of underwater means, new kind of underwater vehicles.
Pierroberto, it's Kriti in London. Thank you for your time this morning. Sticking on that topic, you've been quite vocal when it comes to buying specifically TKMS from ThyssenKrupp. Are you still looking to make a move on that asset?
On that specific regard, we are collaborating with TKMS on a commercial base. We have a lot in common. First of all, the product, and I believe there is a lot of industrial sense in continuing this conversation with them. Also, considering that the market is booming, there is a lot of extra capacity needed in order for that market to be fulfilled. So it's a commercial collaboration whereby we reiterate our availability to be a long-term partner, a partner of choice when it comes to enlarge capacity and better cover the big opportunities on the market.
Well, speaking of some of the opportunities on the market, can you just also update us on the progress when it comes to some of the talks to buy some of the robotics and underwater assets? You've already discussed this a little bit, but when it comes to SAPEM as it merges with Subsea 7, what's the progress? What's the update on that conversation?
We are focused on the organic growth in terms of underwater drones. We believe that there is a huge market for the protection of critical underwater infrastructure. This threat was totally underestimated in the past. There are very few solutions that are solutions. Everyone is looking into technologies. I believe that defense end users, they need solutions. So we are integrating a lot of mature technology, existing technologies into solutions that are sellable today.
Piero Roberto, it's Anna here in studio. You're a European ship maker, and we've heard from the US administration, President Trump being really vocal about wanting to see more ships of all kinds being built in the United States. What are your thoughts on whether we're going to see that develop?
I believe that there is a big potential in the renaissance of shipbuilding in US. First of all, because there is a domestic market, which is highly unsatisfied by local production. We invested in US 20 years ago when nobody was investing over there in shipbuilding. We have a very modern shipyard there. We have a lot of skilled resources, and we have a lot of familiarity with the supply chain in US. So we feel particularly useful for the cause of relaunching shipbuilding in US. It's very important to go to the new doctrine of the Navy, which means to go smaller, faster, cheaper. So that's obviously the new doctrine. And we can be very instrumental to this new doctrine, having, again, 20 years of familiarity with the shipbuilding sector in US, which need to be totally regenerated.
All right, Piero Roberto Folgiero, CEO of Fincantieri, we thank you so much. We appreciate your time this morning. Coming up on the program, we're going to shift a little bit of focus. We're going to talk about what's going on right here in the UK ahead of that budget and how the BOE is thinking, some political jitters in there, all of that coming up with Jordan Rochester next. This is Bloomberg. Welcome back to the opening trade. 30 minutes into today's session and seeing a very weird market picture, at least on the index level. I'll walk you through it. The overall picture higher by 0.2%. It's your third straight day of gains if this actually holds. The outperformer today, though, is the CAC 40. The luxury space really pushing it higher by 0.8%. The underperformer is the FTSE 100, down about 0.3%. Guy, to me, on the surface, I already feel like this is a sector story.
Yeah, it's a single stock sector story. That's basically what we're seeing this morning in terms of the narrative around Europe. There is some macro kind of top-down elements, but there's definitely some sort of single stock sector factors. And to Kriti's point, look at what is happening here. You've got 405 stocks up, you've got 176 down, so it's a 2-to-1 up to down, basically. But the market is still struggling to make headway. Volume is pretty light, it's pretty average and a little light, as it has been over the last few sessions. What have we got going up? ASML's rising a little bit this morning. The movement, the kind of the mood music within the ship space has been better over the last few days, and that continues today. Novo is up as well this morning. It's actually the credit space where Novo is interesting this morning. They're out with a fairly big offering. Merck is also tracking a little bit higher as well, up by 6%. So single stocks kind of are moving. Like, look at Merck. Look at what it's doing this morning. On the downside, Anna's just been talking about what's been happening with Siemens. It is definitely under pressure, as you can see, down by 4%. 3i Group in the private equity space is definitely under pressure. Private equity stocks have been underperforming for quite some time. Look at that this morning. That's a big move. And has the glut arrived? Are oil stocks going to be under pressure? Shell is just one example, but it's a heavyweight in the London market, and it's down by 1.4%. Anna.
Let's talk, Guy, about some of the other stories we keep in focus. And President Donald Trump, has signed legislation to end the longest government shutdown in US history. This marks the official conclusion to a 43-day impasse that halted food aid to millions of households, cancelled thousands of flights, and forced federal workers to go unpaid for more than a month. White House Press Secretary Caroline Leavitt says October jobs and US CPI reports are unlikely to be released. In a scoop, Bloomberg has learned that Alibaba plans to overhaul its main mobile AI app in the coming months to help it more closely resemble OpenAI's ChatGPT. Sources say existing Android and Apple apps are to be renamed Qwen after the company's well-known AI model, with an end goal to try and make it a fully functioning AI agent. And the UK economy expanded at just 0.1% in the third quarter, weaker than both the market and the Bank of England had expected. Bloomberg Economics reports that the sharper-than-expected slowdown can partly be explained by a one-off drop in manufacturing, but also showed the economy is being held back by cautious households. The release comes hot on the heels of Tuesday's weak jobs data and will likely add to the calls for the MPC at the Bank of England to lower interest rates in December. Kriti?
Let's continue that conversation on the UK and what the data really tells us. For more on this, I want to go straight to Jordan Rochester, head of fixed strategy over at Mizuho EMEA. Jordan, pleasure to have you on the program. You've been busy. My inbox has been full, which Jordan Rochester takes on what's going on in the UK. So just give us very quickly your broader read on some of the data that's coming through. Then we'll dive into the political jitters.
Well, Anna just walked through the industrial production figures, and indeed the hack on Jaguar was absolutely pretty gutting in terms of the impact for it. We had over a month of output lost for Jaguar, and for all of the sort of suppliers in the Birmingham region, the Midlands as well. So it's a one-off. Hopefully this is not repeated, but it is a sunk loss. Production was halted and business wasn't done. So manufacturing in Europe in general is in a tough place. So it came at a really tough time. But overall, I'm actually pretty more interested in the RICS data on the housing sector, which came out this morning, because structurally and cyclically, the UK housing data is in a poor place. Lettings in the rental sector are really slowing down. Tenant demand is pretty much at the lows, and even landlords now are responding to that and reacting by lowering their rental price expectations. And this really matters because it feeds through to UK inflation in the ONS data, and it's going to collapse in the next few months, the rental sector. So it's good news if you're looking to rent a flat or a house, by the way. But it's good news for the doves because it means that the services component of UK CPI might not be as sticky as everyone has been fearing on the Bank of England's hawkish side of the MPC. And the other thing as well is we had a big risk for inflation from goods and energy earlier this year. The good news is that the goods inflation, I think, will come off the boil thanks to food prices. So Andrew Bailey had been noting the risk of rising food prices, but globally food prices are really coming off as well. They've gone negative. And chocolate, the price of your chocolate bar will get cheaper because the price of cocoa is down 50% from the highs. Unfortunately, a lot of chocolate bar makers have reduced their cocoa content in response to high prices. I think Penguin bars no longer classify as a chocolate bar. You might correct me if I'm wrong on that, but that was the headline being made today. So what does this all mean for the UK? Well, you've got growth in a pretty tepid place. It's not like Germany or the US where fiscal spending means that it's very easy to be optimistic on Germany and the US. It's difficult for the UK with this budget coming up that's going to raise taxes, and that budget will slow down the economy as well. Overall, it means a lower growth rate, a lower inflation rate than what's priced, and I think it will mean a more dovish Bank of England.
OK, just to linger on the industrial production figures we had out this morning then, Jordan, and I mean, it's interesting to see manufacturing having an impact on our take on the UK economy, because that's not, such a small part of the UK economy, doesn't often get so much mention. But should we discount what happened the last month then, because of it being perhaps a one-off? Is that why we see volatility in the pound this morning? Because the market said this is a weak number, but then said, oh no, maybe it's a one-off, therefore this has little impact on the Bank of England.
Anna, you forget I'm from Birmingham, so I will drop in any opportunity to talk about manufacturing, Jaguar and the likes. It's the home of them. In terms of for the UK, yes, it is hopefully a one-off, but it will have a lasting impact as we sort of try to recoup from it in terms of the lost industrial production. And I think it's actually the structural story of the rise of China is the bigger problem for manufacturing rather than this one-off hack. Because if you look at the rise of Shein and Temu, that's having a big impact on the consumer goods area, with lots of firms complaining about low prices from China. But it's actually in cars with the rise of BYD. The UK is now BYD's largest market outside of China. So there's a structural problem for manufacturing production. I use these examples as anecdotes to try and make the point clear. But it's not just in cars, it's not just in those sort of consumer clothing, it's across everything, where China is essentially exporting its deflation in industrial production goods to the rest of the world. And the UK stands out as one of the ones that most impacted, because it doesn't have the same high levels of tariffs on Chinese electric vehicles that the EU does, and of course the US. But on the services sector, the strength in European services has been quite surprising. So perhaps that feeds through to strong services growth in the UK. So we can't forget, of course, it is a service-based economy. But I just worry with the budget impact that the services sector doesn't hold up as well.
OK, and talk to us about the link between expected tax increases, Jordan, and a slowdown in the economy. Bloomberg Economics out with a piece earlier on this week saying it depends what you spend that tax money on, perhaps. The government trying to talk a lot about investment at this point. Jordan, what is the link between the higher tax environment that we might be in after the budget and the growth rate?
Well, in the first budget the Chancellor did, she actually did raise capital expenditure, and it was a move that had long been waited for by economists, something that the UK had structurally had low levels of investment. If you're wondering why the roads aren't in a good state or the trains, it's because we've had very low government spending on capital expenditure since the 2010s with the George Osborne budgets that we had. But she had to raise taxes to do so, and you had extremely large tax-raising measures in that first budget as well to offset somewhat of the spending that she did. She's actually, the Chancellor has actually mentioned on interviews, on radio and elsewhere, that when they ask her directly, are you going to break your manifesto promises on income taxes, she hasn't really answered the question. She's kind of given vague statements. So that's why there's a lot of speculation that an income tax hike is on the way, where previously they used to give flat denials, so it was very clear it wasn't going to happen. But one of the answers that she gave, I think it was with LBC, was essentially saying that previous chancellors had cut back on investment into spending in order to make the numbers add up, and that's something that she doesn't want to do. So yet clearly she's trying to tread water on her big capital expenditure plans for the NHS and for infrastructure that she announced a year ago. But because of all the circumstances of where interest rates are, where productivity growth forecasts are, where UK GDP growth has been, she's facing this black hole in terms of the numbers don't add up, her fiscal rules are being breached, and she's trying not to break them. That's why she's thinking about an income tax hike. But the way that it's been framed amongst the Labour Party is, from what I can tell, the idea of a basic rate, the 20% being raised, I think probably won't happen. We're talking really the higher rate and the additional rate, which is the 40 and the 45% tax brackets for high-income earners, and also freezing the tax bands, which is the fiscal drag story. So in essence, the working people, the working man and lady, they won't be finding income tax hike. It will be for the additional taxpayers, I think, is where most of the pain will be. But that will lower GDP forecasts. It will lower inflation forecasts. One of the measures that she plans to do is actually directly impact CPI by a VAT cut in energy. By the way, everything I'm saying is the speculation that's in the press, okay? So it's not all baked in, but a cut in VAT for energy would take off about 15 basis points based on a few assumptions from CPI directly. She learned her lesson from last year. She raised VAT on a couple of items. She raised social rents for households, and that added to about 0.5, 0.6 percentage points to UK CPI through those administrated prices. So she kind of added to the problem with her moves last year. She's learned from that. She's trying to do the opposite. So it's going to be actually really difficult for the hawks to look at this budget and say this is inflationary, because actually you've got the Chancellor doing everything she can to do the opposite. Add on top of that income tax hikes, which are on the cards. If they were to happen, that would lead as well to less UK consumption from households, and therefore you've got to lower your growth forecasts, you've got to lower your inflation forecasts.
OK. Jordan, let's just wrap it up. When do you think the first 50 basis point cut comes through from the Bank of England? Because it sounds like that's the picture you're painting.
Well, look, the jobs numbers in the UK are actually so awful in terms of we've just had 32,000 jobs lost in the PAYE data last month, 32,000 jobs lost the month before. This data is volatile, prone to revision. But if I said to you that was US numbers, you'd be saying 50 basis point cut straight away. This Bank of England, though, they've got an inflation mandate, not Labour. So unfortunately, it's 25 in December, 25 every quarter after that, until 3% by July. So we've got a lower terminal rate forecast for the Bank of England than the market.
But your sense is that that's too slow. But you would do it faster.
Andrew Bailey should have voted for a rate cut at the last meeting, last week, in my opinion. He had all the data he needed, but he wanted to wait for the budget, from what I could tell.
OK. Jordan, great stuff. Thank you very much indeed. Jordan Rochester, head of fixed strategy at Mizuho, EMEA. Anna.
Let's talk about some of the earnings stories that have been moving share prices around this morning. And let's start with Germany's Merck. So Merck KGaA reporting better than expected profit helped by new tumour drugs and a strong performance in parts of its life science unit. So it seems to be the life sciences side of things lifting the story over at Merck. Burberry, Guy, has had a very volatile morning. The share price has been all over the place. I see it's settling higher.
Yeah, much higher, 5%. That's a decent.
It was negative sort of 5 minutes into trading.
Absolutely, as the market tries to sort of digest all of this. But yeah, no, I think that's a much more positive picture. It's interesting, though, you set that against the idea that actually the UK, as we've just been hearing from Jordan, is struggling. Clearly, this is a business, once again, that is not UK-focused, but
only 10%, I think.
Precisely, the numbers are absolutely tiny. So how do you think about UK assets in the kind of environment that Jordan has just painted? You've got to be really careful in terms of how domestic focused you're going to be, what you're going to be looking at in terms of the picture. Post budget, what is the divergence going to look like between the 250 and the 100?
I have it on good authority that fashion show was worth seeing and maybe drove up some of that demand that you're seeing around the world. There's another one stock that I've got my eye on. That's Hapag-Lloyd. We were talking about Maersk earlier in the week. They've narrowed their guidance. They're talking about higher demand, falling freight rates. Overall, it's not painting a good picture for their stock, down by almost 3% this morning.
OK, what have we got coming up for you? President Trump signing legislation to end the longest US government shutdown, which had halted food aid, cancelled flights and left federal workers unpaid. We'll have more on that move and what comes next critically. This is Bloomberg.
Welcome back to the opening trade. About 49 minutes into today's session. Green on the screen across the board everywhere but the UK. The outperformer, of course, is in the French market. Some of that's a luxury read-through. The underperformance seems to be a commodities read-through. Nevertheless, net stocks Europe higher by 0.3%. If it sustains, it's a third straight day of gains. I wonder how much of the market indication that was coming over from Washington, where President Trump has signed legislation to end the longest government shutdown in American history, marking the official conclusion to a 43-day impasse.
Today, we're sending a clear message that we will never give in to extortion, because that's what it was. They tried to extort. The Democrats tried to extort our country. In just a moment, I'll sign a bill exactly like we asked Democrats to send us all along, many days ago. This cost the country $1.5 trillion, this little excursion that they took us on.
We're joined now by Bloomberg Managing Editor for the U.S. Economy and Government. Mario Parker is here, as well as our markets correspondent, Valerie Teitel, around the table. Mario, I want to start with you. Just walk us through how we got to this position in the very end. The big sticking point was the ACA credits. Is that off the table altogether?
It's off the table for right now. Democrats are in chaos right now, quite frankly, just given some of the fissures that created this. A group of senators broke rank with their Democratic Party in order to forge this deal. Now, the consolation prize for Democrats is the fact that you do have this message out here as the party that is protecting health care, the party that is in favor of lowering costs or keeping costs low.
Was that not there before?
That wasn't there. And so what happened about a year ago now, over the last 12 months, Democrats just didn't have a cohesive message at all. They were all over the place. I like to say that they were concussed after the knockout blow that Donald Trump delivered them this time a year ago. Well, they finally settled on a message of affordability and that health care, this fight for ACA extension credits, the fact that they were able to get some Republicans on board with the message as well, is a consolation prize here, even as they didn't get a tangible victory with the actual extension of the ACA credits.
What happens next? Are we in a period, an interim period, when we go back to another shutdown come Christmas because all of this is going to resurface? Are we done with shutdowns? How quickly can we get the government open again? Just give us a picture of what comes next.
Sure, absolutely. I think we're shut down out. Just given the fact that what we saw with the 8 Democrats or so who broke ranks, right? So the last thing, I mean, one of the pain points, of course, is the U.S. Thanksgiving holiday is coming upon us. Flight delays, bread lines with federal workers, none of that looks good for Christmas, right? So I think we could set that part aside, again, with the caveat that anything could happen in this Washington, D.C. right now. In terms of how quickly everything can resume, some things won't necessarily return back to normal. Caroline Leavitt, the White House press secretary, yesterday suggested some of the key economic data for October we just may not get. In terms of federal workers getting back to work, they'll start to do that today. In terms of some of their back pay, air traffic controllers are prioritized. Sean Duffy, the transportation secretary, said 48 to 70, about 48 hours for 70% of their pay. We'll get some economic data from September as well, but that's everything else. It's the big airplane that we're moving.
Yes, exactly. And some of those aeroplanes have not been moving for a while, have they, Mario? Val, let's bring you in. And I mean, Mario talking there about the wider activity that is reopening the US government. Part of that, the bit that the markets perhaps are particularly paying attention to, is the data and when we get it. Caroline Leavitt saying certain bits of data we may never see, but even September non-farm payrolls, I saw somebody earlier talking about, well, middle of next week we might have to wait for that. Somebody else saying Friday this week. I mean, what's the expectation for how quickly we get this stuff?
Well, at least the hope is that we do hear from the Bureau of Labor Statistics today on giving us some sort of schedule, some sort of plan, especially with what they mean to do with the October CPI print, which has largely gone uncollected as a data series. But to what Caroline Leavitt said, she was mentioning we will get the September data rather quickly after the reopening. And I do think that's what the market believes as well, due to the fact that the NFP for September was essentially nearly completed before the shutdown began. That could be released rather quickly. I mean, I still am hearing shreds of hope that we could get it actually on Friday. Middle of next week is probably a bit more conservative. But when it comes to the October data, I think that's going to be really key for not just the Fed, but for the markets on how they interpret CPI, not just for the month of October, but for months to come. It is unprecedented that we've gone without a month of collecting data, but I suspect the BLS in this post-COVID world has had some sort of plan if this data collection does lapse for a month. The big question is whether they skip it altogether, because that could lead to some data inferences in the CPI indexes that could warp the data for months to come. Anna Wong has been writing about this, our chief economist at Bloomberg, that it could essentially change some indices, some components until May of next year. And we know that when data collection is a bit in the gray area, markets will just use it to argue whatever point they want. The Fed will use it to argue whatever point they want as well.
Very quickly, Val, talk to us a little bit about the economic hit that's being taken place. We're talking about the data not being a way for the Fed to actually navigate or for it to be foggy or blind or whatever frame of reference you want to use. But the actual hit for people who aren't spending, who you're never going to get that extra haircut rate, like, you know, that you could do 2 haircuts in the following month. What is the actual estimate on the hit?
Look, this has been worries like this have been many times during when we've had government shutdowns. And what we have seen to happen in the past is that any hit to GDP is just made up in the second quarter. It's just delayed until the second quarter. I know COVID was a different circumstance where, as you mentioned, people don't need 2 haircuts after being able to go back into the salon. But I think most are just penciling in that whatever drawback from GDP from this month of being absent will just be added to next month's and next quarter.
Mario?
Okay.
Oh, God.
We're going to wrap it all up there.
Yeah.
Thank you very much indeed. Thanks. It's great to see you. Your time to trip to London is perfect.
Stay here.
Yes.
Stay here, Mario.
We're not done yet.
It's very helpful to us to have you here.
Yes, anyway, Mario, great to see you. Thanks for stopping by. Mario Parker at Valerie Hotel. Let's talk a little bit about what we've got coming up for the rest of the day. You've got 9 a.m. the UK time. ECB is going to publish its economic bulletin. Vilroy is going to be speaking a little bit later on. We get Disney earnings today. I think it was the quote of the day on the Bloomberg terminal this morning, talking about that we should all remember that Disney started with a mouse. Things got bigger from there. Anyway, San Francisco Fed President Mary Daly is going to be talking to us, as will Neil Kashkari. Cleveland Fed President Beth Hammack also up. And St. Louis Fed President and CEO Alberto Whistler joining us. All of that.
I'm looking
coming
for a
up.
deeper message there. We all start somewhere.
We all
Is
start
that
with the mouse.
There we go. That is it for the opening trade. European equity markets, London underperforms, everywhere else goes higher. This is Bloomberg.